All right, let's jump right into this explainer and unpack how a legacy pharmaceutical giant is currently executing a massive strategic turnaround. Today, we're digging into Teva Pharmaceutical's newly released Q2 2026 earnings report. Now, if you follow the pharma space at all, you know Teva has a very deep history, but what the data is showing us right now is a truly fascinating shift. We're going to strip it down and look strictly at the numbers, the pipeline updates, and the strategic moves that are currently defining their brand new era. Here's our roadmap for today. First, we'll cover the pivot to growth strategy. Then, the innovative brands driving their revenue, how they're navigating the generics market, their pipeline and R&D investments, and finally, we'll wrap up with the financial results and outlook. Starting with Section 1, the pivot to growth. To really grasp the numbers we're about to see, we first have to understand the main goal of this entire story, which is Teva's major corporate transformation. Look, Teva isn't just pumping out pills anymore. They are actively modernizing and diversifying their entire business model. As Richard Francis, Teva's president and CEO, put it, this quarter's milestones highlight an increasingly diversified growth profile. They're deliberately moving away from relying purely on their historical strengths to build a foundation that's focused on sustainable, innovation-driven growth. And every single financial metric we're going to look at today ties right back to one of these four foundational pillars. Number 1, delivering on growth engines through their key innovative brands. 2, stepping up innovation by advancing their late-stage pipeline. 3, sustaining their generics powerhouse by leaning into biosimilars. And 4, focusing the business through active modernization and targeted savings programs to really improve those operating margins. Moving on to Section 2, innovative brands driving revenue. Let's see how this broad strategy actually translates into real-world dollars, specifically looking at how those innovative brands are performing right now. Check out this number. In just this second quarter of 2026, Teva hit a massive milestone. Their key innovative brands collectively generated over $1 billion in revenue. That is a 43% year-over-year growth in local currency. So we're not just talking about a slight uptick here. This is a fundamental transformation of Teva's portfolio mix and their overall financial profile. And look at these year-over-year growth engines leading the charge. Every single one of these key brands grew by at least 40% in local currency this quarter. Ajovy global revenues hit $244 million, growing an impressive 56%. Uzedy saw revenues of $77 million, up 43%, and continues to be the fastest-growing long-acting injectable for schizophrenia. And then, of course, there's Austedo, which continued its rapid expansion, bringing in global revenues of $696 million, marking a 40% growth. I mean, these three products are absolutely the heavy lifters of the new Teva. Because of this crazy momentum across the board, Teva actually went ahead and bumped up its 2026 revenue outlook for all three of these innovative brands. They're now expecting a combined 2026 revenue of approximately $3.7 billion from this group alone. That reflects a 17% year-over-year growth at the midpoint. It's hard evidence proving that this pivot is literally working on the commercial side. All right, Section 3, navigating the generics market. Now, we absolutely can't talk about Teva without talking about their historical anchor, right? So, with the new innovative brands surging, you've got to wonder, how is the traditional side of the business holding up under the current market pressures, particularly in the United States? Well, here's the narrative tension for the quarter. Traditional U.S. generics did take a hit. Global generics revenues decreased by 15% year-over-year in local currency, and in the U.S. specifically, generic revenues dropped 31%, down to $660 million. Now, that was heavily driven by increased generic competition for lenalidomide capsules, which is a generic version of Revlimid. But as a counterpunch, their newer portfolio of biosimilars is stepping right in to fill that void. In fact, their biosimilars are on track to deliver $800 million in revenues by 2027. Just to make sure we're all aligned here, a biosimilar is essentially a highly similar and generally much more affordable version of an already approved biological medicine. And Teva is aggressively expanding access in this space. During the quarter, they launched a biosimilar to Eylea called Ozempic over in Europe, and they announced a global licensing agreement for a proposed biosimilar to Ocrevus. They're actively building a robust portfolio of 18 biosimilars, which goes to show they're evolving their generics powerhouse rather than abandoning it. Section 4, Pipeline and R&D Investments. Let's follow the money and see exactly where their research and development dollars are flowing right now. A massive focus for Teva lately is this concept of a pipeline in a product. If you haven't heard this term, it basically means a single therapeutic drug that has the potential to be tested and approved for multiple different diseases. They are heavily investing in these types of assets, meaning one successful biochemical breakthrough could potentially unlock treatments for a wide variety of conditions, totally maximizing their R&D return on investment. You can see this playing out perfectly in their late-stage pipeline. We're talking rapid advancements across neuroscience and immunology. First up, they submitted a new drug application to the FDA for ecopipam, a first-in-class therapy for Tourette's syndrome they recently acquired. Then, the European Medicines Agency accepted their application for olanzapine LAI for schizophrenia. They also reported encouraging Phase 1b results for TEV-408 in vitiligo, with Phase 2 expected in Q4. And finally, Devakatug, their anti-TL1A developed with Sanofi, they announced plans to initiate studies in 2 additional indications, hidradenitis suppurativa and fibrostenotic Crohn's disease. That perfectly demonstrates that pipeline in a product potential we just talked about. Finally, Section 5, Financial Results and Outlook. Let's put the final piece of the puzzle together and look at the bottom line for Q2 2026. Now, you might immediately spot a GAAP loss of 49 cents per share this quarter, but hold on a second. If you look under the hood, that loss was primarily driven by a very specific strategic $726 million R&D expense directly resulting from their acquisition of Emalex and its Tourette's syndrome treatment, ecopipam. It's a strategic investment in their late-stage pipeline, reflecting that exact pivot to growth strategy we've been discussing, rather than any sign of operational decay. Seriously, don't let that GAAP loss fool you. The underlying business is incredibly healthy when it comes to cash generation. In just Q2 alone, Teva generated a robust $622 million in free cash flow. That is a highly solid metric showing that their daily operations are throwing off significant cash to help fund these new R&D investments and manage their debt profile, presenting a pretty stark contrast to that GAAP loss figure on paper. So despite a tiny 1% dip in total USD revenue, landing at $4.1 billion for the quarter, the broader financial markers are looking really solid. Gross profit margin actually increased to 52.0%, largely thanks to the favorable mix of those high-margin innovative products like Astido. On top of that, Fitch recognized their significantly improved balance sheet and raised their corporate credit rating to an investment-grade BBB-. And finally, they've maintained a strong 2026 total revenue outlook of $16.5 to $16.85 billion. The strategic pivot is, without a doubt, financially sound. As a final strategic move to optimize their cost of capital and broaden their investor base, Teva announced a major transition. They are replacing their American Depositary Share Program with a direct listing of ordinary shares on the New York Stock Exchange starting in September 2026. This move is specifically designed to support their potential inclusion in leading global indices, cleanly aligning their stock structure with their modernized corporate strategy. Which brings us to a close today, and honestly, it leaves us with a pretty massive question. As Teva shifts to this direct NYSE listing, and as these biosimilars and innovative growth engines totally reshape their revenue mix, just how radically different will this pharmaceutical powerhouse look 10 years from now? They are clearly leaving their pure generics legacy in the rearview mirror and stepping fully into a diversified, innovation-driven future. It's going to be a fascinating journey to watch unfold. Thanks for joining me for this explainer, and keep learning.